Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are trying to tell us and sometimes what they are trying to hide. Today we are diving into the latest filing from BlackRock Capital Appreciation Fund Incorporated. And let me tell you, it's a treasure trove of numbers that really paint a picture of where this massive fund is putting its money and how it's performing. So right off the bat, what's the big story here? It's all about how this fund is investing in big technology names, and the performance of those investments is having a huge impact. We're going to break down the key holdings, the sector allocations, and of course, the financial health of this fund that manages billions of dollars. Stick around to see which companies are making the biggest waves in BlackRock's portfolio. Don't forget to subscribe and join our Discord community linked in the description below to keep the conversation going. Let's start with BlackRock Capital Appreciation Fund. Inc. itself, think of this as a giant pool of money from many investors managed by professionals at BlackRock. This particular report covers the period ending the 30th of November, last year 2025. First off, let's look at the sheer size of this operation. The fund has a massive $3.8 billion in net assets. That's a huge amount of money changing hands every single day. Now, how is all that money invested? It is spread across 42 different holdings. That is a pretty concentrated portfolio when you think about it, especially for a fund managing nearly $4 billion. Concentration can mean higher potential rewards, but also higher risks if those few companies don't perform well. Let's decode where the money is actually going. The report breaks down the investments by sector, and one sector absolutely dominates. Over half of the fund's assets, a whopping 52.7%, are invested in the information technology sector. This tells us BlackRock is betting big on tech, and that's a trend we've seen across the market. But this fund is leaning in even heavier. After technology, the next biggest slice is communication services at 13.6%. This includes companies involved in things like social media, internet services, and telecommunications. It's a sector that often goes hand in hand with tech. Then we have consumer discretionary at 12.9%. Which means companies selling non-essential goods and services, like online retailers or entertainment companies. What is interesting is how much of the fund is concentrated in just a few companies. The top 10 holdings alone make up a significant portion of the fund. Let's look at the very top of that list. Nvidia, a major player in graphics chips and artificial intelligence, makes up 12.9% of the entire fund. That is a massive bet on a single company. If Nvidia does well, it significantly boosts the fund's performance. If it falters, it could drag the fund down considerably. Following closely is Microsoft, another tech giant, at 8.9%. And then Amazon.com, the e-commerce and cloud computing leader, at 8.5%. You can see a pattern here. It is heavily weighted towards the biggest names in technology. When you look at the entire list of top holdings, you'll see names like Apple, Meta Platforms, Broadcom, Alphabet, Tesla, and Eli Lilly. This isn't just a tech fund, it is a fund heavily invested in the dominant forces shaping our digital lives and, increasingly, our health. Now, let's talk about the price of admission for this portfolio, or in simpler terms, the costs. For a hypothetical investment of $10,000 in the institutional shares class, the costs over the last 6 months were $36. That translates to about 0.67% annually. For managed funds, this is a pretty reasonable cost, especially considering the scale of management. It means for every $1,000 invested, about $7 goes to managing the investments. However, if you look at other share classes, the cost can be higher. For instance, the investor shares cost $49 for that same $10,000 investment, which is 0.92% annually, and the investor C shares come with a cost of $89, a hefty 1.67% per year. This shows how much the share class can impact your actual returns. Those higher costs for investor C shares, for example, mean that almost 17 out of every $1,000 goes towards fees annually. That's a significant chunk that directly reduces your investment growth. The report also provides other key fund statistics. The portfolio turnover rate was 34%. This indicates how actively the fund managers are buying and selling securities within the portfolio. A 34% turnover means that about a third of the fund's holdings were bought or sold during the period. This isn't excessively high, suggesting a relatively stable approach to picking investments, but it's not static either. Active trading can generate short-term capital gains, which might have tax implications for investors. Let's dive into the financial statements where things get a bit more detailed. Here we see the balance sheet for the fund as of the 30th of November 2025. The bulk of the assets, over $3.8 billion, are investments in unaffiliated companies. That is where the market fluctuations we discussed earlier really hit. On the liability side, we see a small negative number here, which generally represents things like accrued expenses or payables that are a bit larger than any minor other assets. And that brings us to the final net assets figure, again close to $3.8 billion. A slight difference from the previously mentioned net assets could be due to rounding or the inclusion of other minor assets and liabilities. These financial statements also show activity across different share classes. For example, looking at the institutional shares financial highlights, we see the net asset value per S-share starting at $43.25 and ending at $45.91 for the 6-month period. This resulted in a total return of 13.49%, and that's not annualized, meaning it's the actual return for that 6-month period. That is a solid return, showing the fund performed well during this time. Now let's put on our Warren Buffett hat for a moment and try to see the bigger picture. This report from BlackRock Capital Appreciation Fund, Inc. shows a clear strategy, heavy investment in big name technology and growth companies. The fund's performance is closely tied to the success of these tech giants, as evidenced by Nvidia, Microsoft, and Amazon being the largest holdings. This concentration provides potential for strong returns if these companies continue to innovate and grow, but it also exposes the fund to significant risk if any of these key players stumble. The costs associated with managing the fund are competitive, especially for the institutional shares, but investors in other classes like Investor C should be aware of how those higher fees can eat into their returns over time. The report also highlights the importance of understanding the specific share class an investor holds, as costs can vary significantly. A key takeaway here is the fund's performance is highly dependent on a few dominant companies in the tech sector. While that's been a winning strategy recently, it's crucial for investors to understand this concentration and assess whether it aligns with their own risk tolerance. Diversification is a commonly cited principle in investing, and while this fund is diversified across 42 holdings, the top few really dictate the overall performance. So, what's my take? BlackRock Capital Appreciation is a powerful engine fueled by big tech. It is performing well now, riding the wave of innovation. However, investors need to remember that what goes up fast can also come down fast. The risks are real, and the fund's direction is closely tied to the fortunes of a handful of massive corporations. It is a bet on continued tech dominance. Definitely something to watch closely. What's your take on this fund's strategy and its top holdings? Are you invested in any of these tech giants? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate filings. And for those who want to connect and discuss these topics further, join our Discord community. The link is in the description. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.